You are listening to Uranium Spotlight on Tuesday, March 11, 2025. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, tariffs shake up the uranium markets. Germany sets out to lower energy costs, and Goviex files their feasibility report on Muntanga. The spot uranium price closed last week at $63.95 a pound, down from $65.30 a pound, continuing its downward trend. Market activity was slow, with 5 spot transactions totaling 600,000 pounds of U3O8, bringing the annual volume to 9.4 million pounds over 89 deals. On the long-term side, utility contracting remained quiet. Only 3 smaller mid-term utility contracts were awarded last week, part of a broader trend of subdued term market activity. While many utilities are expected to enter the market in the coming months, formal activity has been minimal. So why is the uranium price sliding this year? Well, first, discretionary spot demand has dropped. Buyers who were previously stockpiling uranium amid geopolitical uncertainties have largely stepped back. Second, utilities remain cautious, opting for off-market negotiations rather than public term contract commitments. And third, mid-term carry trades have become more active, leading some sellers to shift volumes away from the spot market. While prices are soft today, the fundamentals remain tight, with utilities eventually needing to re-enter the market. The question is, when will they pull the trigger? Until then, expect uranium prices to drift on light volumes. The turbulence surrounding U.S. tariffs on Canadian and Mexican goods rattled markets this week, with uranium equities particularly affected. President Donald Trump briefly imposed a 10% tariff on Canadian energy, including uranium, alongside a 25% tariff on other imports from Canada and Mexico. Though the tariffs were quickly reversed, the brief implementation sent shockwaves through the market. By Monday morning, many uranium stocks had shed 4 to 5% as investors reacted to the sudden policy shift. Nuclear industry leaders and Canadian officials were quick to push back. Doug True, Chief Nuclear Officer of the Nuclear Energy Institute, acknowledged the broader goal of enhancing U.S. energy security, but warned that these measures could ultimately hinder growth and innovation in the sector. Saskatchewan Premier Scott Moe highlighted Canada's strategic advantage in any trade dispute, not just in potash and oil, but in uranium as well. Saskatchewan alone supplies more than a quarter of the uranium used in U.S. nuclear reactors, making it America's largest supplier by far. With U.S. domestic production unable to meet demand, restrictions on Canadian uranium would only add strain to an already tight market. Cameco noted earlier this year that any U.S. tariff would simply drive up uranium prices across the board. Global sellers would adjust their pricing just below the tariff threshold, increasing uranium costs for U.S. utilities without providing any competitive advantage to domestic producers. For U.S. reactor operators and uranium investors, the risk far outweighs any potential benefit. Even if the U.S. were to attempt a large-scale ramp-up in production, its recoverable uranium reserves, roughly 539 million pounds, or just 1% of the global total, would be insufficient to sustain its nuclear fleet for long. Canada, by contrast, holds 10 times that amount, ensuring a stable supply of fuel for U.S. reactors. Though the tariffs were quickly repealed, the episode underscores the ongoing uncertainty in the uranium sector. A stable and cooperative trade relationship between Canada and the U.S. remains crucial, not just for the uranium market, but for North American energy security as a whole. Following last week's reporting on Germany's election, where pro-nuclear candidate Friedrich Merz secured victory, Germany's nuclear technology lobby, KernD, has stated that up to 6 of the country's reactors could be restarted. However, there's a stark contrast between what KernD is saying and what the reactor operators themselves are claiming. Germany's nuclear plant operators insist that restarting the reactors isn't feasible due to staffing shortages, high costs, fuel supply constraints, and regulatory barriers. But KernD, which includes German subsidiaries of international nuclear firms like Westinghouse and Framatome, argues that a government subsidy of $1 to $3 billion, the process could be straightforward. KernD also emphasized the increasing power demands from artificial intelligence, data centers, and high-tech industries, sectors that require massive amounts of electricity, which Germany could supply if nuclear power returns. Without it, energy costs may continue rising, threatening the country's industrial base, which has struggled with high fossil fuel prices since the Russia-Ukraine war and the shutdown of its reactors. Meanwhile, Germany's government has just set aside a $500 billion infrastructure fund and eased borrowing rules to jumpstart economic growth following last year's mild recession. Some of these funds and policy adjustments could be directed towards reviving nuclear power, addressing staffing and fuel concerns through targeted subsidies, and adjusting regulations under the country's most pro-nuclear government in decades. While Germany has a sufficient share of wind and solar energy, their intermittent nature forces reliance on fossil fuels, especially in the winter, when shorter days reduce solar output. Without nuclear in the mix, Germany faces continued challenges in achieving energy security and stabilizing industrial power costs. Goviex Uranium has taken a major step towards its Muntanga project in Zambia, filing a feasibility study that reinforces its position as one of the few near-term uranium projects capable of supplying a tightening market. The numbers are compelling. An after-tax net present value of $243 million, an internal rate of return of 20.8%, and production set to average 2.2 million pounds of U3O8 per year over a 12-year mine life. The project is highly sensitive to uranium prices, with an extra $45 million in value added for every $5 increment in the U3O8 spot price. From a cost perspective, Muntanga benefits from shallow open-pit mining, industry-standard heap leaching, and low acid consumption, all of which contribute to a projected operating cost of $32.20 a pound. Infrastructure is also in place, with road access, grid power, and established export routes via Namibia. CEO Daniel Major highlighted that with financing secured, production could begin in as little as 2 years, with first uranium expected within 4 months of mining. Goviex is already engaged Endeavor Financial to help structure financing, considering debt, royalties, and offtake agreements. This feasibility study puts Muntanga on the map as a credible future producer. As the uranium market remains tight, projects like this, low-cost, scalable, and well-positioned, could be pivotal in meeting rising demand. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.